Well, minutes from the Bank of Canada's January meeting show that officials find it difficult to foresee when rate cuts could begin. However, they did reiterate that the conversation in the next little while should be shifting towards how much longer rates need to stay at 5%. And then perhaps the cuts could come after that. Let's bring in Randall Bartlett. He's Senior Director of Canadian Economics at Desjardins for his take on what we got out of the summary of deliberations here. Randall, was there anything in particular that jumped out to you?
I think the thing that jumped out to me most was just how much the Bank of Canada is struggling to know when is the right time to start cutting rates. It sees risks really on both sides of its inflation outlook, where we're seeing that underlying inflation is still remaining elevated, and there's a risk that it could remain sticky going forward, and that would mean potentially that rates would need to stay high for longer. Whereas at the same time, those high interest rates are weighing on consumers as they continue to renew their mortgages, and we're seeing that consumption per capita has been declining for the past several quarters. And so really there are risks to both sides of the outlook for inflation and for the economy. And the Bank of Canada is really going to be looking at each data point as it comes in to help make that decision of what might be the right time to start cutting rates.
Yeah, and really making that clear that they're still concerned about inflation at this point and the underlying pressures. And they talked quite a bit about wages and productivity and the concern there that if productivity doesn't pick up in a pretty substantial way, that the wage gains that we've seen could add to the troubles on the inflation side of things.
Yeah, that's right. I mean, strong wage growth is really only a problem when you don't see it accompanied by productivity growth. And that's really what we're seeing now is just quarter after quarter of negative productivity growth, but wage gains in the 4 to 5% year over year range. And so there is a risk that, so a lot of that is catch up, but there is a risk that we could start to see that feeding into broader underlying inflation, which still remains elevated in the sort of 3.5% to 4% range. And so the bank wants to see that wage growth start to come down in a meaningful way that's going to be more consistent with getting inflation back to its 2% target.
Yeah, because how likely do you think it would be that we would see exceptionally strong productivity gains, Randall?
I don't think we're going to see strong productivity gains anytime soon. I mean, a lot of what's weighing on it now is that we're seeing that, that employment is still strong. We're seeing that growth in hours worked is still strong. And so that's really meaning that, growth in labor input is outpacing growth in overall output. And so we're not expecting to see that turn around anytime soon. We've seen a dearth of capital investment in Canada, particularly lately, but, over the last decade plus. And so something really needs to start to give to start seeing meaningful business investment in Canada and meaningful productivity gains to go along with it.
I wonder what you make of the comments on the housing market as well in these minutes. So saying that they discussed the risk that if the housing market rebounded more than expected this spring, that shelter inflation could also be one of the risks to keeping inflation materially above the target. How are you thinking about the possibility for that to happen when we have seen activity already picking up in the housing sector?
That's a real material risk. We put out our bottom-up inflation forecast last week, and it's shelter inflation that's really driving the outlook that we have, as well as the Bank of Canada over 2024 and 2025. And so the bank really needs to see that as long as shelter inflation is high, that other sectors, other components of inflation that are more domestically driven need to start coming down well below what's typically consistent with this 2% target to offset the strength of shelter inflation. And so, if home prices rebound and mortgage interest cost remains high, that could mean that shelter component just continues to drive underlying inflation higher. And so, again, that means that rates need to stay high for longer in order to ensure the rest of the core inflation basket is weak enough to offset that over the outlook and get inflation back to 2%.
When we heard from the governor, Tiff Macklem, speaking yesterday, it seemed like he was sort of separating the Bank of Canada from the housing market and, the impact that interest rates have on the housing market. So how do you think that he's thinking about that in particular, the need to be keeping those rates higher I mean, I guess if you're talking about it from the inflation standpoint, then yeah, they care about inflationary pressures, so they would be. But how do you make sense of it?
Yeah, I mean, it's challenging for the Bank of Canada because mortgage interest cost is the single largest component that's driving headline inflation right now in Canada. But at the same time, monetary policy has to be restrictive to bring down overall inflation and those factors that aren't directly a reflection of higher interest rates. And so, look at the speech yesterday. What it said to me was the Bank of Canada making clear that, yes, there is an impact of monetary policy on shelter, but the affordability crisis that we're experiencing in Canada is not the result of monetary policy. When you look at what happened with affordability in Canada after the global financial crisis, it had gradually eroded in the decade prior to the pandemic, and then ultimately, eroded that much faster during the pandemic as home prices really took off. And as we've seen population growth be very strong since, that's helped to actually keep prices more elevated than we would expect in an environment of high interest rates. And so there are a lot of factors causing affordability to have eroded in housing. One is a structural lack of supply. Another one is population growth, and then the third one ultimately is the impact of higher interest rates, which is probably third on that list. And so Bank of Canada is just saying, look, it's not all a function of monetary policy. There are other structural factors that we need to think about to help improve housing affordability in this country.
Yeah, when you think about those price gains, though, Randall, during the pandemic and leading up to it too, and you think about how low rates were at that time, that had to be part of the fuel and the fire there. When it comes to those comments from Macklem yesterday, as well in that speech in Montreal, there was something that jumped out to me, and it was him sort of reflecting about when they started to raise interest rates. And he said that they could have started sooner. They could have started withdrawing stimulus sooner. And I think that was the first time that I had heard him sort of reflecting in that way, that maybe they could have started sooner. I just wonder what you made of that and what sort of a difference you think it could have made.
Yeah, I mean, I think that's become generally accepted wisdom. And while he may have been more explicit about that yesterday than he has in the past, we've certainly had hints of a little bit of regret, I think, on the part of Bank of Canada and other central banks for not possibly starting sooner. I think that the Bank of Canada certainly could have started sooner. So could the Fed have, and other major central banks around the world. But at the end of the day, hiking rates by 50 basis points, a meeting earlier or something along those lines wouldn't have had a material impact on where inflation, I think, ended up at the end of the day. I mean, a lot of it was driven by goods price inflation, constrained supply chains, supply side factors that the Bank of Canada just didn't have doesn't have any real control over or influence on. And so I think that those rates would have had to have gone up much earlier and still fairly aggressively in order to have an impact. I don't think one or two meetings would have made much of a difference.
Yeah, there's